Welcome back to the final video of our series From Zero to LBO. In this video, we will analyze the takeover of Twitter by Elon Musk and see how our model performs using real-world information and data. In this respect, we will look at the available information covering the takeover and the restructuring measures post-closing. In the end, we will compare different revenue scenarios to see whether the takeover could be successful and how our model performs. The objective of focus is to see whether the going concern of Twitter is at risk looking at the leverage of the transaction. So let's get started. Before we jump into the analysis, a brief disclaimer. Please note that this video is for educational purposes only. We define simple assumptions to briefly analyze scenarios and restructuring measures. The analysis is simplistic and hence the analysis will only cover a small part of the potential future development of Twitter. So please feel free to comment to share your view on the development of Twitter or just drop a mail to receive the model to play around with your own ideas. First, we look at the news coverage of the takeover itself to find out what were the basics, meaning valuation, leverage, etc. As you can see, the total consideration was 46 billion, covering 44 billion purchase price and 2.5 billion so-called closing costs. We assume that closing costs relate to the repayment of remaining debt at Twitter and fees associated with the transaction. The purchase price represents a revenue multiple of 8.6 times 2021 revenue and bears a premium of almost 40% looking at Twitter's market cap as of April 1st, 2022. Furthermore, the acquisition is financed using 13 billion or almost 16 times adjusted EBITDA of 2021. According to news reports, the acquisition financing will bear interest expenses of 9 billion in the next 7 to 8 years. Based on that, we assume an interest rate of 9% for the 13 billion debt financing and a constant repayment until maturity. So at a glance, the valuation seems rather high for the underlying asset. Next, we look at the restructuring measures implemented after the takeover, which in our case are headcount and infrastructure cost reductions. Headcount was reduced by 50% and we try to model the reduction based on the average salary of $233,000 per annum, as mentioned in the Wall Street Journal news report. Furthermore, we use additional information regarding stock-based compensation, which we collected from the 10K 2021 of Twitter. More on that in a second. Regarding infrastructure costs and the announced cut of 1 billion annually, we have to check whether this is plausible based on the 2029 financials. As you can see in a minute, a cut of 1 billion solely looking into the P&L is not very plausible. Therefore, we are also considering capital expenditures in this instance. We will show you that in a minute as well. Last, we define best, base, and worst case scenarios for revenue development of Twitter. The best case is based on the pitch Elon Musk gave to equity investors with revenue reaching 28 billion by 2028, including 10 billion coming from subscribers. The base case is basically assuming a steady, increasing growth rate in advertising sales, but with a lower share in subscribers reaching a 7% share in 2027. The worst case assumes no growth in 2023 and 24, and growth slowly picking up in 25. Share of subscribers in the worst case is growing from 0.5% to 3% in the planning horizon. For 22, we do not anticipate any growth in either case due to the turbulences in the past month, leading to a slump in revenue for Q4. Please note that Q4 was always the strongest quarter in the past 3 years in terms of revenue, as we have seen in our previous video. However, as I said, all assumptions are simplifications. So here we see our inputs and assumptions summarized. Please note that we assume that all restructuring measures are constant throughout the cases. This is clearly a simplification, and you should always consider effects on profitability on a case-by-case view. In our case, we solely focus on top-line scenarios. We assume that the restructuring measures have been planned prior to the closing and anticipated by the buyer independent of any revenue development. So let's see how we plugged in the numbers into our model. First, we created a new supporting sheet to calculate the restructuring measures, starting with headcount. So we plugged in the headcount numbers over the past years with the recent cuts of 50%, leading to an overall staff number of 3,750. After that, we collected stock-based compensation information by cost center, as stated in the last 10K of Twitter. The information was used or is used to calculate the share of each cost center of total stock-based compensation, which then is used to calculate an estimate for headcount of each cost center. We use the average salary of $233,000 to calculate total personnel costs, which are then used to break down cost centers using additional information of the respective 10K section. The subcosts are divided using assumptions apart from the calculated personnel cost. So in this instance, for example, we assume that infrastructure costs, meaning hosting, etc., make up 70% of total residual cost of revenue. Please note that we also have depreciation and stock-based compensation, which we show here. Afterwards, we assume that for personnel costs, the respective percent or share of total revenue is split in half for a new adjusted share of cost of revenue, which then is used in the later calculation. I will show that in a minute. So this results in a reduction of personnel costs in case of cost of revenue of 30 million. We repeat this task for each cost center, and in addition also assume a reduction of infrastructure costs. As we mentioned earlier, the 1 billion reduction is not quite plausible for the P&L figure standalone, as in our assumption, the costs amount to roughly 900 million. So what we do here is we assume that these costs are reduced by half, meaning that we save up to 440 million US dollars in costs. But we also reduce the capital expenditures by almost this, together with the P&L cost reduction, leads to an overall saving of 1 billion in infrastructure costs. To support top-line growth, however, we assume that capital expenditures will pick up in the planning horizon and reaching a 20% share of total revenue by 2027. So please note that especially in 2022 and 23, depreciation in our case, will be higher than capital expenditures, and that means that the asset base is affected. Normally, you should have an equal weight at least, as capital expenditures are always a key parameter in defining valuations and stuff like that. So next, we plug in the transaction financials in the sources and user sheet. Basically, the key ingredient here is the new capital structure, which is used to calculate interest expenses and debt services in the coming years. The respective rates and amounts for debt service are inserted in the KPI and assumption sheet, as you can see here. So the sales cases or revenue cases are defined as mentioned, so we are ready to compare the cases. For that, we create a simple data table to compare KPIs across cases and see how Twitter would be affected in the different scenarios. Based on our assumptions, we see that Twitter would need additional financing in the base and worst case. The best case is looking quite good. However, based on the high profitability of 56% EBITDA margin in 2027, this is not a surprise. The base case with an almost identical growth in advertising revenue is more interesting due to the high leverage, leading to high interest expenses and debt services. Additional financing model through our working capital facility, the 12% interest rate is needed. So this sums up to roughly 1.6 billion over the planning horizon. The worst case shows a significant requirement for refinancing in the short term, illustrating the importance of top-line growth for Twitter. However, there's one item which could be a game changer, at least in the coming years, and this is short-term investments. As you can see here, in 2021, short-term investments amounted to 4.2 billion, and this represents a significant capital reserve and at least gives some time for Twitter. So if we assume in that from 2023 to 25, 1 billion is used annually, we see that the base and even the worst case improve quite a lot. So the base case is now in a shape that we do not need any additional financing. And even the worst case looks from a total interest expenses point of view quite interesting. Summing up, Twitter is condemned to grow to support a huge debt burden and safeguard a concern. This burden could be too heavy to bear, so a refinance could be plausible in the coming years. However, there are capital reserves on Twitter's balance sheet providing a certain financial buffer. In the end, all could work out. Looking at the financials, if the restructuring measures and top-line growth initiatives work out. As you see, our analysis is rather simplistic. However, it gives some interesting insights rather quickly. Our model is quite handy. However, more details are of course required to form a substantiated opinion on any company. So with that, I would like to thank you for watching our series From Zero to LBO, building a financial model of Twitter. Although we will upload an extra video on Monte Carlo simulation, the analysis concludes our series. I hope you enjoyed building this model with us, and we highly appreciate your support. So please leave a thumbs up and subscribe for additional videos. Also, please leave a comment if you're interested in the models for other public or private companies. In addition, we will upload videos on other financial topics in the future. If you're interested in this model and a comprehensive guide on how we build the model, please drop us an email to the address in the video description. Thank you and bye bye.